If you've been following silver at all this week, you've probably noticed the tone shift. Headlines are louder, thumbnails are more urgent, and there's a lot of talk about what has to happen next, especially heading into Monday. Some channels are framing it like a binary event. Either silver breaks out decisively or the whole move collapses. Others are tying Monday to everything from central bank activity to mysterious positioning shifts, suggesting that if you own silver and don't act immediately, you're already behind. My goal today is to take that intensity down several notches and replace it with clarity. Yes, Monday matters. But not because something dramatic has to happen at the open, and not because silver's long-term fate will be decided in a single session. It matters because of what the market is positioned for going into the week and how that positioning interacts with price behavior. This is Financial Briefing. The focus here is calm, data-driven analysis, not clickbait or conviction theater. We're going to walk through what the numbers actually say, what they don't say, and how I'm personally thinking about silver as we head into the next trading week. Before we get into the data, I want to ground this discussion with accountability, because context only matters if you track outcomes. Back in late February, when silver was trading around $23, we said the probability favored a move toward $25 before any meaningful pullback. That played out over the next several weeks, with silver pushing to just over $25.50 before stalling. Not perfect timing, but directionally correct. In early April, when silver briefly dipped below 24 and sentiment turned negative, we said the downside risk was likely limited unless gold broke down as well. Gold held, silver stabilized, and prices recovered into the high 20s by May. More recently, in early June, when silver was approaching 30 for the first time in years and optimism accelerated, we said the move was constructive but stretched short term, and that volatility was likely. Since then, silver has traded in a wide range between roughly 30 and 33, frustrating both late bulls and aggressive bears. That doesn't mean every call was perfect. It does mean the process has been consistent, and the outcomes have been tracked honestly. So let's turn to the present moment, because the reason Monday matters has less to do with headlines and more to do with where silver is sitting relative to key levels, positioning, and short-term expectations. Silver is currently trading in the low $30 range, roughly $31 to $32 depending on the session. That puts it well above its long-term averages, but not in uncharted territory. Over the last 5 trading days, daily ranges have expanded, with intraday swings approaching $1 in some sessions. That volatility is the first data point that matters. Over the last 30 sessions, silver's average daily range has increased from about 50 cents to roughly 85 cents. Historically, that kind of expansion doesn't signal trend exhaustion by itself, but it does signal a transition phase. Markets don't stay in high volatility equilibrium for long. What this means is that traders are adjusting risk rapidly. Stops are getting hit, new positions are being added, old positions are being questioned. This usually happens near decision points, not resolutions. What it does not mean is that volatility guarantees a breakout higher. Expanded ranges can precede both continuation and correction. Treating volatility as directional is one of the most common mistakes I see in this market. The second data point is futures open interest. As of the latest reporting, COMEX silver open interest sits around 155,000 contracts. That's up from roughly 135,000 a month ago. Participation is increasing. That's a fact. Historically, during major silver advances, open interest rises alongside price until it doesn't. When price continues higher but open interest stalls or reverses, that often marks exhaustion. We're not there yet. What this means is that the market is attracting new capital. There's genuine engagement, not just short covering. What it doesn't mean is that there's an imminent shortage or forced resolution. Those narratives tend to surface whenever open interest rises, and they almost always exaggerate short-term implications. The third data point that's particularly relevant heading into Monday is short-term momentum relative to longer-term structure. Silver's 50-day moving average is currently near $29. The 200-day moving average is closer to 26. At current prices, silver is roughly 10% above the C, 50-day and over 20% above the 200-day. Historically, silver spends the majority of its time within plus or minus 8% of its 50-day average. Being above that range doesn't mean silver must fall, but it does mean upside is no longer cheap. What this tells us is that silver has momentum, but it's borrowed momentum. The market needs either time or price to rebalance that relationship. What it does need to tell us is that silver is overbought in a way that forces an immediate decline. Overbought conditions can persist for weeks in strong trends. They just increase sensitivity to surprises. Taken together, these 3 data points explain why Monday matters more than usual. Not because silver needs to explode or crash, but because the market is positioned in a way that will amplify reactions to relatively small pieces of information. From here, the conversation naturally turns to scenarios. What could reasonably play out from this setup, and how likely each outcome is. To understand what could happen next, especially as we move into the start of the week, it helps to step back from the noise and lay out the scenarios clearly, not as predictions, but as ranges of outcomes with probabilities attached. Let's start with the bullish case, because there is a legitimate one, and it doesn't rely on silver saving the system or anything dramatic happening overnight. The first bullish factor is structural. Silver is trading above $30 for the first sustained period in more than a decade. From 2013 through 2023, prices above 30 were rare and short-lived. Markets tend to remember levels like that. Holding above them, even with volatility, often changes long-term perception. The second bullish factor is real rates. Even with the 10-year yield near 4%, inflation-adjusted yields remain relatively low by historical standards. Silver has historically performed best when real yields are flat to slightly negative. We're not in a tailwind environment, but we're not in a headwind either. The third bullish factor is industrial demand. Solar, electrification, and grid investment continue to absorb silver supply. These aren't discretionary trends. They're policy-driven and multi-year in nature. That doesn't push prices higher every week, but it does create an underlying bid. The fourth bullish factor is positioning. Despite the excitement online, silver is not heavily owned by institutions. Most large portfolios remain underweight precious metals, and within that small allocation, gold dominates. Silver still has room to attract incremental capital without becoming crowded. If these factors dominate, the bullish scenario is that silver consolidates briefly and then pushes higher into the mid-30s. A move toward $34 to $36 over the next 1 to 3 months would be consistent with past cycles following long base breakouts. I assign that scenario a probability of about 25%. Not the base case, but high enough to respect and plan around. Now let's talk about the bear case, because this is where many investors underestimate how quickly silver can turn against them. The first bearish factor is stretch. At current prices, silver is meaningfully extended above its short and medium-term averages. That doesn't force a decline, but it increases vulnerability to disappointment. When expectations rise faster than confirmation, corrections tend to follow. The second bearish factor is speculative behavior. Managed money-long positions have increased faster than physical demand indicators. That creates asymmetry. If price stalls, those positions can unwind quickly, pushing silver lower even without new negative information. The third bearish factor is macro sensitivity. Silver is not just a monetary metal, it's also an industrial one. If growth expectations weaken, or if yields rise unexpectedly, silver can come under pressure even if inflation remains sticky. The fourth bearish factor is silver's own history. False breakouts are common. Moves above key psychological levels often attract momentum buyers, who are quick to exit when progress slows. In the bearish scenario, silver fails to hold $30, slides back toward the 28 to 29 zone, and spends time frustrating late buyers. That would not invalidate the long-term thesis, but it would reset sentiment and positioning. I put the probability of that outcome around 30%. Which brings us to the middle case, the one that rarely makes headlines but shows up most often in reality. In the middle case, silver continues to trade in a wide, volatile range between roughly $30 and $33. There are false breaks in both directions. Headlines alternate between optimism and disappointment. But underneath that noise, the market digests gains and builds structure. This kind of action feels uncomfortable because it doesn't reward emotional decision-making. It rewards patience. I assign this scenario the highest probability, around 45%. Now, probabilities alone don't mean much unless they're anchored in context. So let's zoom out and look at history for perspective. One useful comparison is the 2010 period, when silver broke above $18 after years of consolidation. The initial breakout was not clean. There were sharp pullbacks, weeks of sideways action, and plenty of opportunities to get shaken out before the eventual acceleration. The similarity today is the long base and the break above a psychologically important level. The difference is the macro backdrop. In 2010, monetary policy was aggressively accommodative. Today, policy is restrictive. That matters for speed and magnitude. Another comparison is 2020. Silver broke out rapidly from the high teens into the mid-20s, driven by extraordinary liquidity injections. That environment doesn't exist today. What we have instead is slower, more selective capital deployment. So history suggests that upside is possible, but patience is required. That brings us naturally to cross-market signals because silver doesn't trade in isolation. Gold is holding near record highs, around $2,300. That's supportive. But gold is not accelerating, it's consolidating. That usually argues for stability rather than explosive follow-through in silver. The dollar index is range-bound, hovering around 104. It's not collapsing, but it's not breaking higher either. That's a neutral backdrop. The 10-year yield remains elevated near 4%, but has stopped rising aggressively. Stability in yields removes a major headwind, but it doesn't create a strong tailwind. Taken together, these signals point to balance rather than extremes. Now let's talk about positioning more directly. Commitment of traders' data shows that commercial hedgers have increased short exposure as prices have risen. That's expected. They hedge production when prices are attractive. Managed money has increased long exposure, but not to extremes. Net longs are elevated, compared to the past year, but still well below levels seen during major peaks. Institutional behavior outside futures markets remains cautious. Silver ETFs have seen inflows, but not panic buying. Pension funds and endowments remain largely absent. This tells me the market is active, but not euphoric. All of that sets the stage for the most important part of this discussion: what to actually do. With this information, this is the point where analysis has to turn into behavior, because understanding the setup is only useful if it changes how you act when volatility shows up. When I think about silver heading into Monday, I'm not asking whether the market is bullish or bearish in some absolute sense. I'm asking what information would actually force me to change my positioning and what information I'm prepared to ignore. That distinction matters a lot right now. Let's start with positioning, because this is where short-term risk usually builds quietly. The most recent commitment of traders' data shows managed money holding a net long position that's elevated compared to the last 12 months, but still well below historical extremes. Commercials, as expected, are carrying larger short exposure, largely as a hedge against higher prices rather than an outright directional bet. That balance tells me two things. First, the market is leaning bullish, but not stretched to the point of fragility. Second, if price fails to follow through, there's enough speculative length that a pullback could be fast, even if it's not deep. Institutionally, silver still isn't a priority asset. Most macro funds that want precious metals exposure are still expressing that view through gold. Silver remains a secondary allocation, which limits both upside acceleration and downside panic. That context shapes how I approach risk. Here's my current framework. If silver opens Monday above $31 and holds that level on a closing basis, I do nothing. I stay patient. That tells me the market is comfortable carrying positions into the week and absorbing supply. If silver dips below 31 intraday but reclaims it by the close, I still do nothing. Intraday volatility is noise at this stage. I care about where the market settles, not where it flinches. If silver breaks below $30 and fails to reclaim it within 3 to 5 trading days, that's a different signal. In that case, I reduce trading exposure modestly, not because the long-term thesis is broken, but because short-term momentum would have turned against the position. If silver pulls back into the 28.50 to 29 zone and stabilizes there, I add incrementally. That area lines up with prior consolidation, the rising 50-day moving average, and improved risk-reward. I don't try to catch the exact low, I scale. On the upside, if silver breaks above $34 and holds it with expanding volume, I reassess. That would suggest the market is willing to accept higher prices without immediate profit-taking. In that scenario, I look at trailing stops and partial profit targets rather than chasing fresh exposure. As of now, my total silver allocation sits at about 10% of my overall portfolio. Roughly 6% of that is physical silver, held as a long-term position with no intention of trading. The remaining 4% is liquid exposure that I manage more actively. For that actively managed portion, my stop loss sits around 28.50. That level isn't perfect, and it isn't sacred. It's simply where the structure would change enough that I'd rather step aside and wait for clarity. My first take profit zone on part of that position is around $36, not because 36 is the top, but because at that point, the market would likely be pricing in a lot of optimism, and trimming makes sense. Everything beyond that is conditional. And just to be explicit, this is not advice. It's not a recommendation. It's just my framework shared for transparency. Equally important is what I'm not doing. I'm not panic buying because silver looks exciting on a chart. If I missed a move, I missed it. There will always be another setup. I'm not consuming fear-driven or hype-driven content to guide decisions. That includes both extremes. Collapse narratives and moonshot narratives are equally corrosive to judgment. And I'm not assuming that silver needs a crisis to justify its price. Silver can move higher in a slow, uneven way driven by supply constraints and steady demand. It doesn't require drama to work. This discipline matters because silver has a habit of testing emotions. It rallies just enough to trigger fear of missing out, then pulls back just enough to trigger regret. The investors who do best are the ones who refuse to react to every swing. Now let's talk about what I'm watching very closely this week, because this is where Monday fits into the bigger picture. The first thing on my watch list is daily closing behavior around $30. Not intraday spikes, not wicks, closings. If silver continues to close above 30 despite volatility, that's constructive. If it starts closing below and staying there, risk increases. The second thing I'm watching is volume relative to direction. I want to see whether rallies are being confirmed by expanding participation or whether upside moves are happening on thinning volume. The former supports continuation. The latter often precedes reversals. The third thing I'm watching is gold's behavior relative to silver. If gold holds steady near 2300 while silver weakens, that's a warning sign. If gold holds steady and silver holds its gains, that's confirmation. Silver rarely sustains strength in isolation. Secondary to that, I'm watching the dollar index and the 10-year yield. A sharp move in either would matter. Continued range-bound behavior reinforces the base case. All of this brings us back to why Monday matters. It's not because Monday will decide silver's long-term fate. It's because it will reveal how comfortable the market is carrying risk at current levels. Markets speak through behavior, not headlines. In the final part, I'll pull this together with a clear summary, revisit the probabilities one last time, and close with the broader takeaway for both long-term holders and shorter-term traders. Let's bring this to a close by stepping back and looking at the full picture, because by now it should be clear that this moment in silver is less about drama and more about discipline. Silver heading into Monday is not at a finish line. It's at a checkpoint. On one side, there are real reasons the market could move higher over time. Price is holding above a level that capped it for years. Industrial demand continues to absorb supply. Gold is holding near record highs, which tends to support the broader precious metals complex. And institutional ownership of silver remains relatively low. On the other side, there are equally real reasons to be cautious in the short term. Silver is extended relative to key moving averages. Volatility has expanded, which means reactions will be amplified. Speculative participation has increased faster than confirmation from price. That's why probabilities matter more than predictions. The bullish scenario is that silver digests recent gains and then pushes higher toward the mid-30s. That outcome is plausible, especially if gold remains firm and macro conditions don't tighten further. I keep that probability around 25%. The bearish scenario is that silver fails to hold 30, pulls back into the high 20s, and forces a reset in sentiment. That would frustrate late buyers, but leave the longer-term structure intact. I assign that outcome roughly a 30% probability. The most likely scenario, in my view, is the middle one. Choppy, volatile consolidation between roughly $30 and $33. Time passing, expectations cooling, structure improving quietly. That's where I put the highest probability, around 45%. And that's why Monday matters. Not because it has to deliver a verdict, but because it will give us information about how the market wants to carry risk at these levels. Does it absorb volatility or does it reject it? Does it defend key levels or does it test lower ones? For long-term holders of physical silver, the takeaway is simple. The next few days matter less than your ability to stay disciplined. Volatility is not your enemy unless you let it dictate your behavior. For shorter-term participants, the next few days matter more, but only if you've defined in advance what matters to you. Levels, time frames, risk limits. Without those, every headline feels urgent and every move feels personal. So here's the clean summary. Silver is above a major long-term level, but not in a confirmed runaway trend. Volatility is elevated because the market is deciding, not because it's breaking. Now, the bull case and the bear case both exist, and neither deserves full confidence. And the most likely outcome is patience being tested before direction becomes clearer. That's not exciting, but it's honest. If you value calm, data-driven analysis that focuses on probabilities rather than promises, consider subscribing to the channel. This is Financial Briefing. Stay sharp. Silver at 30 plus. What the market is deciding next.